Hey guys, so today I want to talk about why I think value investing is the most difficult way to invest. It is quite possibly, now this is just my opinion, but it is riskier in a sense. Um, and I think the one key that you need to develop if you are going to be an individual stock picker, especially a value stock picker, is patience. Now, the market's going to do what the market's going to do, but you need to develop patience with yourself. If you run out of patience, you can make bad decisions and sell out of stocks. Trust me, I've done it. I've done it plenty of times. When you see that chart, I'll try to pop that chart up here if I can find it, where the average investor makes about 1% um, as an investor, whereas if you just would have, went with a broad-based ETF like VOO, you would have made 7-10%. I'll find that chart and I'll put it up, and it is absolutely 100% correct. Why do I know that? Because I made about 1% in my first year of investing. Now, why did I only make 1%? Lack of patience. When you have a lack of patience, it's going to cause you to do things that you shouldn't do. And I'm going to go through a few stocks here. I got 4 stocks here that I'm going to go through, and these are all popular stocks. They're all large cap stocks. And the reason why I'm pointing them out is because a lot of new investors, they'll look at stocks like this and go, "Ooh, I'm going to buy this." Well, if you do not have the long-term focus and patience with these stocks, you may get so frustrated that you'll just walk away. And that, really negates the purpose of value investing. Value investing is a long-term game. It is not a get rich quick or it could bleed you. That stock could bleed for years before it actually pays off. Now, do you have the patience to go for years without seeing your investment do anything except either go sideways or down a little bit? And would you continue to buy as long as the fundamentals of that company stay either the same or improve? Then you should just hold on and keep buying, in my opinion. But the problem is we get in the way. Now, the first stock that I got up here is ExxonMobil. Now, everybody knows that the oil sector has been under pressure. And if you look at this 5-year chart, I'm using a 5-year chart on all of these that I'm going to highlight here. So back 5 years ago, this thing was, in the $90 range. And here we are, 5 years later. We've gone through the ups and downs, but it's consistently kind of tracked lower. And now here we are at, where are we at? We're at $59.99. So at $60. But when people were over here at 70, they were thinking, "Oh, this is the time to buy." You had article after article, "Oh, this is the time to buy." And then it looked good for a little while, got back up to $95, and then went right back down to 78. So this is not the patience factor is really, really strong here, because you have to hold this thing throughout this whole thing. Okay? And these are all popular stocks I'm highlighting. Next up, IBM. And a 5-year chart. Here we are. Same thing. So here we are 5 years ago. This was about $160. And look where we're at 5 years later. We're at about 154. So this is kind of, in a sense, this is kind of what value investing looks like. You know, and we'll go to some longer term charts here in a minute, just so you get a picture of long term. 5 years is not long term. A lot of times, you know, the reason why investors will make 1% is because they'll look at, you know, one year timelines. They think, oh, that's enough. But you know, you look at these 5-year charts on these popular companies, and they're not that great. Another one, 3M. Everybody knows 3M, huge company. You know, we'll look at the 5-year chart again. And 5 years ago, this at price-wise was at $165. And here we are today, closed today at $160.15. Do you have the stomach for this as a long-term investor? Next up, Wells Fargo. Look at this at a 5-year chart. This thing's gonna whip you around and beat you up. If you look at this chart, I mean, sheesh. What was it 5 years ago? It was 50, 53, 54 bucks. Now we're at 47.85 after hours today. And look at that. So last on my chart is going to be what I feel is kind of the unpopular one, and I don't even have money in it, although I should. And I actually suggest all new investors do so as well. And that is the ETF VOO, which is the S&P 500. Now look at that chart in 5 years. It's a lot more easier to digest. You know, this is just market returns. Now those other four, was it four? Yeah, other four stocks wouldn't, you know, it's not even close. This thing 5 years ago was 190 bucks. It's now 307.56. So what was a better buy at what time? So individual investors, you know, if you have the patience, and that's what we're going to get into next, if you have the patience and the companies perform the way they're supposed to perform, and you can outperform the market on a long-term basis. Now let's take a look at some of these companies, and where I'm at is the etfchannel.com, and what you do is you just punch in a stock. We'll start with the first one, which was XOM, ExxonMobil, and right down here where it says XOM performance, it gives you a range. So we're going to look from January 1st, 1995 up to the close of business today, which is, what is that? 2005, 2015. That's 25 years of history. That's if the company goes back that far. And we're going to compare it just to the S&P 500. Now what this does, let me zoom in on this, see if I can zoom in on it. Excuse me. What this does is it charts $10,000 invested in the stock that you chose, and you can compare it to a benchmark. And you start date of January 1st, 1995, your end date of February 10th, 2020, and you click that button. And that brings up Oh, I can't zoom in on this. But that brings up ExxonMobil. And you can see right here, it shows you from 1995 till 2020 that ExxonMobil had an average annual total return of 8%, whereas the S&P 500 had 9.37%. So you'll see that the S&P 500 beat ExxonMobil over that 25-year time period. So is ExxonMobil a good buy now? Who knows? But let's move on. Let's check out IBM. Hit enter. And we will do the same thing. January 1st, 95 till February of 2020. We'll benchmark that to the S&P 500. Hit click. And we'll see that IBM, this is with dividends reinvested now. IBM pretty much matched the market, 9.25% versus 9.37% of the S&P 500. Now, some of these, if you didn't reinvest the dividends, which is interesting because if you didn't reinvest the dividends, IBM actually beat the S&P 500 if you didn't reinvest the dividends in either one. And that's just because of dividends being reinvested at a higher price, which would bring your cost basis up, essentially, if you reinvested. There's nuances of that, but for the most part, you want to reinvest your dividends. And then we'll check our next one, which was 3M. And we'll do the same thing, benchmark it to the S&P 500. And we'll see that 3M actually beat the market over that 25-year time period. It's roughly 25 years. 3M had a 10.15% return average, whereas the S&P 500 had the 9.37. Now, I've already ran these, so I know what happened, but this one kind of surprised me. Wells Fargo was our last one on the list. And we'll do the same thing. I thought for sure Wells Fargo was going to be the worst performer due to the 2008 recession. So we'll benchmark this to the S&P 500 again, hit click, and you can see Wells Fargo, even with the 2008 recession, blew away the S&P 500. Wells Fargo had a 11.14% average annual return versus the 9.37 of the S&P 500. So, do you have the patience? That's really what it comes down to. Do you have the patience to hold on to some of these outstanding companies that haven't really done anything for the past 5 years? Do you have the patience to weather that 5 years of essentially nothingness, right? To realize long-term business gains. So patience. Patience is the key. Patience is the key. You can't, if you find you do not have patience, the real best course of action is to make sure that you have a very large portion of your investments in an S&P 500 index fund, a total stock market index fund, something of that nature. Because if you don't have the patience, being in these 4 stocks that I highlighted, for 5 years, you could be sitting on no gains. And then it'd be really bad if you sold out because you ran out of patience with the company. So anyway, those are my thoughts on beginning investors, and the most important metric in my mind on what a new investor should be looking at, instead of trying to turn your money over fast. This is a long sum game, and you can play it, but you got to play it long. Anyway, I hope this helped. I hope you got some value out of this. If you did, please leave me a comment down below, and we'll talk to you later. Thanks. Bye-bye.